Okay, we're ready to start this section, this module 5, chapter 8, I believe it is. And with the first thing we're going to look at, as we did on in the notes in the lecture part, we're going to figure out the actual price of this asset that we're purchasing because it has lots of different components coming in. So remember, anything that gets the item ready to use goes into the price. And we don't want to get carried away. We don't want to put we want to make sure what they're giving us we actually want to use. And it's not something different. Okay, so for this one, we got the purchase price of $12.5. It says here that we have a discount option. And if you may want to pause this and read through it. I'm not going to take the time and read through it all. But if you go down to the bottom, it says they pay for the machine within the discount period. So they get that 2% discount that we've talked about a week or so ago. We just want to get out our calculator. I don't think you can see this, but just get out your calculator, do 12,500 times 2%, it's 250. So we're going to put in here less the discount of 250, so it knows then to take it away from our purchase price. Then the seller prepaid the freight charges, adding it to our invoice. So that's something that if it gets added and we have to pay for it, we're going to put in freight charges of $360. The machine requires special steel mounting and power connections. So that's something we need to have to get it ready to use. $895. So we're going to see what they call it. It's probably just steel mountings. Yep. Mounting and power connections. $895. Another $475 is paid to assemble. Oh yeah, we got to put in assembly. Any installation cost of $475. And moving this the machine, $180 were damaged. That's not part of getting it ready. Damages are separate. That's a separate expense. That's not part of normally getting it ready. That's not something that we would normally expect. So we don't put the 150, the 180 in damages. Materials costing $40 are used in adjusting the machine. Yep, that's part of getting it ready to get what we need. So we're gonna put here materials used in adjusting, 40. And this adjustments are normal for this machine and are not a result of the damages. Okay, so yeah, as long as it was normal, we can put it right in there. Now, that's also, it looks like the machine, instead of us putting it on our books for $12.5, we actually would debit our machine for $14,020 and credit basically cash. Let's go ahead and check the work, make sure we got everything correct, and we do. Okay, for the second one, this is taking us now to the next step of my lecture notes, looking at land. We're going to purchase a chunk of land and then eventually put a building and some landscaping and different things around it. So if we notice here, the negotiated price was $280,000 for the lot plus $110 for the old building. I could care less about the old building. I don't even want the old building because you can see here it costs us an extra $33,500 to tear down the building. So that building is unfortunate that it was there. Otherwise, I could have just bought it for $280 and saved this and the $33,500. And then we had to pay an extra $47 to fill and level. The rest of this is putting on new buildings. So I'm going to worry about this in a minute. Let's just worry about these first few items. These are all items that get the land ready to use. So when I come over here and debit land, you should be able to see the calculator. I'm going to put in the obviously the cost of the land. And unfortunately, I have to put in the cost of the old building. I had to pay for that. I'm going to put in the cost to tear down that building. That's part of getting the land ready to use. And I'm going to put in the cost to raise and flatten the land to get it ready to move the trees and whatever else needs to be done. So total land cost, $470,500 is going to be my first debit. Tells us here, record the total cost of the plant assets. So basically we're putting everything into one journal entry. It says we paid 1.5 million for construction. That is 1.4 for the new building, and then the rest is to land improvements, parking lots. Remember, those are separate because they can be depreciated, whereas land is not, but buildings are. In buildings, land improvements usually can depreciate faster than buildings. Buildings are going to be there for a while, typically. So I'm going to debit my building, and I hate we have to keep scrolling back and forth. This is 1,452,200. 1,452,200 for debiting, and then I'm going to come down here and do land improvements. That's for the parking lot and the paving and the lighting. 87,800. Tells us here, prepare a single journal entry, all of which were paid in cash. Probably unlikely, but okay. So we're just going to add them all up, see how much cash we paid. So I'm going to credit $2,010,500. Our entry, and let's check the work. Let's go to the next one. This one's very similar to what we just did. It's buying stuff, getting the land ready to use. So I'm going to skip this one. Okay, this one is dealing with straight line depreciation, and it's saying do it for the second year. It's we're gonna look at it from, looks like 3 different or maybe at least 2 vantage points, maybe the third one here, and maybe this third one is the journal entry. So let's go ahead and do this one. It's what generally when you are doing something like this, and especially in the book as well, you're gonna in word form pick what your numerator is. So if we go back to the straight line, remember the numerator is your cost minus the salvage value. So that's what we want to look here, and yep, cost minus your salvage value. The denominator was the useful life. So we're going to put the useful life here, and that equals my depreciation. So now let's actually put in the numbers. Cost minus salvage value. This item cost me $43,500. Salvage value of $5,000. So we can do the, you should be able to do this mental math. $38,500. Estimated useful life, 10 years. That's what it tells me in the problem. So it's saying every year I'm going to depreciate $38,50. Now it tells me that this was purchased at the beginning of the year. So in year 1, we would have depreciated it fully. So therefore in year 2, we're going to depreciate it fully again, $38,50. The reason why that year 1 is important is because we needed to figure up the book value. So remember, book value, simply take your original cost, $38,500. That's your depreciable cost. Take your original cost, subtract out year 1, $38,50, and subtract out year 2, $38,50. This is what's still my equipment is still worth, book value, $38,500. Let's check and see how we did on number 4. I must have put that in wrong. Yep, 35,800. I just transposed those numbers. $35,800. All right, let's check just to make sure. All right, that looks good. Now number 5, same thing, except on this one we're using the units of production. So if you remember with the units of production, you use the same starting point, cost minus the salvage value, and then you divide by your total units of production. So This is basically step 1 and step 2. They just put it together in one step, because I had this just as one step, and then putting these two together is 2 steps. All right, so cost minus the salvage value, that's still 38.5, same from the other problem. Total units of production, it tells us here 385,000. It's telling us that it's 10 cents per item I make. All right, here it's saying, okay, how many units did you actually make? And we made 32.5. So therefore, our depreciation expense is simply 32.5 times 10 cents a unit. So just move the decimal. So that's 32.50. Let's check the work. And that looks correct as well. Finally, on number 6, it's wanting us to use the third method, double declining. Okay, so for the double declining, it says choose the factors. Remember, with double declining, we don't use the salvage value right away. So all we do is we got to use the original cost. The beginning, you can use beginning book value. I think that's what they want you to put in here, because technically you are using the beginning book value, especially for year 2, if we were doing year 2, because we don't want to use the original cost every single year. The choose the factor, we're going to use the double the straight line rate. Straight line would have been 10 years, so 1 out of 10, 10%. So we're going to use 20%. All right, beginning book value for year 1 would simply be 43.5. We don't do anything with salvage value. Double the straight line rate, we talked about that, that's 20. And it does the calculation for us. This would have been my depreciation expense for year 1. Now, year 2, I can't use 43.5. I got to use 43.5 minus all of my depreciations added up. Well, I only have 1, so I'm at 34.8. Beginning book value for year 2. Multiply that by still 20, and then I get my depreciation cost for year 2. Let's go ahead and check the work. And that looks good. Okay, I'm going to skip through this one. This one is just basically doing the straight line for all the years. And when you're all said and done, you should get to the your final ending book value should be what the salvage value is, like how we did in my car example problem, where we ended at 4,000 salvage value. So 7 and 8 will go together. Actually, I'm going to go ahead and go through number 8, because the double declining is different. Remember how, because we don't use the salvage value till the end. So I think this one may be beneficial to go through. It's the harder method. So our beginning year book value, let's look at our problem here. The beginning of the year, so that's good. We don't have to do any partial year. We purchased equipment for the 154, and we're going to use it for 4 years. Equipment value of 25 grand, or salvage value. So beginning is 154, that's simple enough. The depreciation rate, since we're having it for 4 years, if I was doing straight line, that would be 1 divided by 4, which is 25%. We're going to double that, so that's pretty high. That's 50%. So therefore, my depreciation is going to be a pretty high number. 154 times 50%, 77,000. I don't have any prior depreciation, so that is my accumulated depreciation. And it's kind of weird, since it's half, we take 154 minus the depreciation, that's 77,000 still. It's not going to usually be like that, but for the first year, when it's a 50% rate, that's how it works out. Now that end year book value becomes my beginning of the next year book value, so that's another 77,000 here. I keep using the 50%, so 77 times 50%. I'm going to depreciate 38.5. My accumulated depreciation, take the 38.5 plus my previous 77,000. So I'm at 115.5. My year-end book value, take the 77 minus my current year depreciation, 38.5. And it's 38.5. What happens when you do the 50%? It makes it so they come out the same. Okay, now we got to start looking at this guy, the 25,000. I cannot go below that. So I need to figure out what's the difference. How much do I have left until I get to 25,000? 13.5. So I may want to jot that down on a side sheet here. I'm going to put down 13.5. And I know that when I do my next calculation, I can't do more than 13.5 as my annual depreciation. So let's see what it comes out to be. If I put in 38.5 here, and then I multiply 38.5 times 50%, it's more than the 13.5 that I'm allowed. So this annual depreciation has to stop at 13.5. That brings my accumulated depreciation started at 115.5, and then add in the 13.5 from this year. So I'm at 129. And if I take there's different ways you can go about getting the book value. This is a different way than I did earlier. Take the 154 starting. That's where you started at, your opening amount, 154 minus the total accumulated depreciation. That is all the lower I can go because that's my salvage value. So then in year 2020, annual depreciation, nothing, can't depreciate any. I'm still at the 129,000 for accumulated, and I'm still at 25,000 book value. Let's go ahead and check the work. And that looks good. So the key with this one, the hard part, is filling out this number, the 13.5, and not taking just the 50%. And then knowing that in the final year, nothing is depreciated. We can't go any lower. Okay, this one is going to be a little different. This one is going to be a good one to go through because we're actually, as you can see here, we bought a machine, 4-year life, and the opening salvage value. But at the beginning of the 3rd year, they decide, ugh, we didn't estimate it right. We actually have 3 more years left and a new salvage value. So we have to redo the depreciation for this year on, in year 3 on. So let's get the company up to date after it says here, compute the machine's book value at the end of the 2nd year. Well, all right, so we got to kind of do the steps off to the side because they just want to put the actual final amount here. So our cost of the asset is 23,860, but let's see how much we've depreciated. All right, so it doesn't say here that I bought it at the beginning of the year. We're gonna, I guess, have to assume that since it doesn't say otherwise. So we're gonna take the 23,860 minus the salvage value, and it's saying we've got a 4-year life. All right, so that means in year 1, I would have depreciated this much as long as I had it for the whole year. Now, it's saying how much is my accumulated after 2 years. So I'm just going to want to multiply that number by 2 for 2 years. So my accumulated depreciation is 10,730. Therefore, my value, 13,130. I'm going to make a note. I don't know if it's going to carry that number over for us. 13,130, because we're going to need that number. Nope, it didn't carry it, so that's good. I wrote it down. Okay, 13,130, book value of point of revision. 13,130. That's the number we're going to be using from here on out. We've already depreciated some of the equipment, so we can't use this beginning number anymore. We have to use what's still left, the value worth. Updated salvage value is $2,000. So the remaining depreciable cost, that's just taking 13 minus, remember that's how we get depreciable costs. So it'd be 11,130. It says here that we determined we have 3 more years remaining, so 3 years. My depreciation will then be 11,130 divided by 3, so 3710. Go ahead and check the work on that. All right. Okay, let's go ahead and do this one. This one is kind of a mix of doing adding into the capital cost of the asset or calling it a normal expense. And I think on this one, since things are changing and I don't know, I can't remember if I don't think there's any T accounts. So I like to keep T accounts sometimes when a problem has more than one or two little parts. I think you'll find that this is helpful if you do this off to the side and not try to just remember everything. All right, so let's scroll down to our equipment area since that's what we're talking about. And we'll put these numbers in as we go. All right, this company pays $264,000 for equipment. It's going to last us 4 years, $29,000. Salvage value. Prepare journal entries to record the following costs related to the equipment. All right, so right now, oh, they don't ask us to do any depreciation. So I don't know if I didn't necessarily need to do T accounts on this one. We would have definitely needed to if we were doing, keeping track of the equipment's worth. I don't think we're gonna need to though. So let's just go through and do these normal. During the second year, $22,000 was paid for a new component to increase the productivity. So that's something big. That's something that's going to make it worth more. Remember, there were 3 things that we're going to count it and put it into the equipment as a capitalized cost if it increases its value, increases its useful life, or makes it something kind of different. Well, this does one of those is it increases its value, makes it more productive. So what I'm going to do is I'm going to debit the equipment for the $22,000. We don't call it a betterment cost or whatever, any expense. It just goes right into the equipment and credit cash. And the second thing, paid $62.50 for normal repairs to keep the equipment in good order. So this would be like an oil change, something that we expect that we had to do. It's kind of almost a yearly thing, maybe not quite yearly. It's just a normal wear and tear. So this would be considered a normal repair expense. So let's see what they call that. I'm just putting in expenses and then see what pops up. Yeah, repair expense, $62.50. And it says we paid cash for that as well. Now for the third one, fourth year we paid $14,000 for repairs. So that's typically going to be a repair expense, but it says it's expected to increase the useful life. We're going to add another year. So therefore we got to update our depreciation, update the cost of the equipment. So this goes actually to the piece of equipment since it updated its useful life and made it last longer. So we're going to simply debit the equipment here for $14,870. And it says paid cash. Let's check the work. And it all looks good. Okay, this is a good one to look at for gain or loss. So we've briefly talked about gain or losses. When I look at this one, it says we have a machine with how much we've depreciated. So with that information, I can determine what the actual book value still is. If you take 250,000 minus 182, you get 68,000. So I'm going to write that number down. That's what it's worth to me on my books. So if I sell it for less than that, I'm going to have a loss. If I sell it for exactly that, which is rare, I'm going to break even, no gain or loss. More than that, then it's a gain. Oh, the first one here, it was needing extensive repairs, so nothing was received, kind of like throwing it out. So all of it was a loss. So what we're doing, what did we get? Nothing. So cash is nothing. Now what I need to do is, if I'm looking at, this is where it might help to have a T account up. We had $250,000 equipment, accumulated depreciation of 182. We are throwing it away. We need to get rid of these amounts. So the first one to get rid of, since it's a debit, we need to get rid of our accumulated depreciation. So accumulated depreciation, 182. I also know that I need to get rid of my equipment. I'm going to skip a space. This is, they call it machine. 250 grand. I needed to get rid of that, so I need to credit 250. The difference, obviously, my debits don't equal my credits. The difference is a complete loss. I have a loss on disposal of the milling machine for the entire 68,000. Now on this one, I'm still going to have a loss because I sold it for less than what it's worth, 68, but at least the loss isn't as bad. So I put my debit, what I'm getting, and then usually the credits are what you're giving up. But if you're giving up a contra account, then it's going to be a little different. You're going to have to debit it as well, just like we did above. Debit the 182. I'm going to skip a line because I know that I'm getting rid of my milling machine. 50. Now, if I add up these two, 35,000 cash plus the depreciation that I've taken. My debits are only 217. I need to get them up to 250. So the difference is 33,000 that is my loss. Loss on sale. If we sell it for the exact right amount, which is again rare, it's going to be a really simple journal entry. We're simply going to show the cash, show that we've depreciated it by the 182, and credit my milling machine for the 250. If you add up my debits, 68 plus the 182, 68 plus the 182, you get 250. There's no gain or loss that needs to be shown. The final one here, we're actually getting more than what the book value is. So we do it almost exactly the same, except when we're getting more, we're going to show it as a gain. Remember, gains are credits. Cash, 80 grand. Get rid of the accumulated depreciation. That was 182. Get rid of my milling machine, 250. Now, if you add up the debits, 80,000 plus 182,000, I'm over by 12 grand. So that means I need another 12 grand over here. And that is what my gain is. 12 grand. Let's check the work. And okay, this one we're going to look at copyright. We purchased a copyright oil painting for $418,000. It protects the owner for 10 years, and we plan on using it for 11. Doesn't matter how long we really plan on using it. How long is the copyright going to last me? Because people can start using it after that. So I'm guaranteed 10 years, so I need to depreciate it by 10 years. Or in this case, we call it amortizing. So simply record the purchase of the copyright of the oil painting. You actually debit copyright. That's an actual asset. So let's find that copyright for 418. It says I bought it with cash. The journal entry was easy. Now record the year-end adjusting entry. Instead of depreciation expense, you call it an amortization expense. And we do it evenly over 10 years, so just move the decimal. So that would be 41,800. And credit your accumulated amortization. Record the entry. Let's check the work. And that looks good. The last one we're going to look at is goodwill. And then we may have a journal entry that goes along with it, but this will be kind of where we're going to finish up as we did with our notes. The company, they purchased it for $2.5 million. The assets, everything added up was only $1.8 million. So the difference is how much goodwill there was, which is easy on this one, just $700,000.